Hi, welcome to Market in a Minute. So, we have a couple of questions we have unresolved, and I'm sure the market is thinking the same thing. Is this a Trump recession, or is it just simply a correction in technology, or maybe a bear market in technology because the expectations have gotten too high? So, typically, the first year of a new presidential cycle, you do get a recession. So, maybe this is a Trump forced recession. We'll have to see how it plays out. So the economy. So thinking about, is this a Trump induced recession? So you put these tariffs in place, right? Or you threaten to put the tariffs in place. Somebody listened. So the net exports into the United States, so net exports, so which is really the imports into the United States. So the imports bring down the GDP minus what we export. So if you look at these numbers, they're rather remarkable. So we went from having expectations from GDP now, the Atlanta Fed's numbers, from having a 2.3% GDP outlook for the first quarter. Last week it was down to negative 1.5%. On Monday, it went down to negative 2.8%. And it's all from a couple different things. One is the net exports being very strong, hurting GDP. And then the ISM numbers weren't so great on Monday either. The internals in the ISM were not great. But then the real personal consumption expectations have fallen dramatically from roughly 2.3%. So that was kind of in line with the GDP growth to 1.3 to now zero. We talked a little bit about Walmart before, maybe last week or the week before. So we talked about Walmart cutting expectations down to 3 to 4% nominal growth for this year. That's not real, that's nominal. So just keep in mind, if inflation is running 3 or 2.5, you have very little real growth occurring using Walmart as a barometer. Now, we made the observation about a month ago that, hey, these earnings reports aren't looking great. So they're coming in on a little bit of the weak side. And so we were a little apprehensive about what we were seeing. We see employment on Friday. The employment reports on Friday, it's expected to be 159,000 jobs. Gosh, if that's a real number, I would take the under on this one. The government was adding 40,000 jobs per month. I don't think they're going to hit 159,000 jobs. You can see this big drop in GDP. It's incredible how far it's dropped. Given how far it's down, I would expect a negative GDP number for the first quarter as we get more and more data coming out. Auto sales were not great either. That came out on Monday. So all the data is coming out. It's coming in on the much weaker side. The valuation of the stock market. Things are improving, believe it or not. The 10-year Treasury up at 4.8 has dropped down to now just under 4.2%. So that's a massive decline. That's really helped the value of the stock market quite a bit. We think that the trend in inflation, even with the tariffs coming, is going to moderate. So as we cut back all the government spending, increase production, increase the economic production of the economy, you're going to produce more goods, more services. You take that production out of government or lack of production out of government, put it to the private sector, you have a pretty compelling thing that will occur. Now the tariffs. So the tariffs, we think there's probably about $1 trillion, maybe more than $1 trillion, but about $1 trillion in goods that will be hit with a 20 to 25% tariff. So assuming that it's about 25% on $1 trillion, you get to about 0.8% bump to the inflation rate. So we think that there's some offsets. You know, the country that's selling us the goods and the people that are importing the goods and then the currency, you probably don't get to 0.8. You maybe get to about 0.4. So something like that. When M2 is growing at a slow pace, it's really hard to pass along these higher prices. What you get is slower economic growth or maybe negative economic growth. So that's the offset. So maybe the inflation isn't so high, and that's really not a real positive thing for the stock market really in the short term. That the inflation rate is staying kind of where it is because with these higher import prices, that means that the economic growth will be slowing. Now the the PE for the overall stock market is currently around 21.8 times. We all know that why the stock market is so highly valued is because of the tech sector. That's starting to correct in a big way. So these multiples are coming down. At the same time that the yield of the 10-year Treasury is coming down, if you just do the inverse of the 10-year Treasury, you get 23.8 times earnings. Okay, that doesn't have a risk premium associated with it, so it's not completely accurate. But we haven't had a risk premium on the stock market for such a long time. It's really nice to see that because the 10-year Treasury coming down, we have one. So when recessions hit, what generally happens is the valuation of the stock market comes down to 15 or 12 times, sometimes it's less. So there's a long way to go in this PE correction sort of market if we would go into a recession. So that's our concern about the stock market. If we do have a real recession, not just basically one because of tariffs or moving workers from the government to the private sector, but a real recession, this market has a lot more downside. We're not seeing it at this point in time. We're not seeing the data to support that conclusion yet. The technicals. So this is the S&P 500 here. We had to keep drawing this map today, or keep doing keep drawing this chart today, as the market continued to decline on Monday. So we see that the markets are in a range, roughly 6,100 on the upside, 5,800 is where the support line is. So we think that the market has a reasonable shot at staying in that band. We wouldn't be surprised if it broke down to the 200-day moving average, which is about 57.25, and maybe goes lower. The real good support is around 5,200, but we think that there is more downside to the overall market. The markets are really oversold. The sentiment's really negative. If we would get some positive data points, the market will pop. It'll have in our mind, a sort of a bear market, big move all at once. So just keep in mind, if you're thinking about shorting the market, it's probably you're a little bit late in that thought process. The Russell 2000, it's been decimated. I mean, it went down. I shouldn't say decimated. It's really come down in a big way. It broke for that 200-day moving average. It's in a downtrend. It's down about 12% off the high. We'd like to see it down about 20% off the high, which would be right around this level here, which we would think that would be a compelling buying opportunity as long as we don't have a real recession. So this is the area that we want to invest in for the big upside in the markets to occur, maybe sometime this year or in the next year. We're thinking sometime this year this will be a really good place to have a nice position built around these smaller companies that benefit from the Trump policies when they fully get executed. NVIDIA. So we mentioned last week we don't like NVIDIA. We like it less than we like Microsoft. We don't like Microsoft either. We think both have to reset expectations. You can see how this thing's kind of rolling over here. Here's where it closed on Monday. It's broken below that support line. It broke below the 200-day moving average. Stocks are kind of hard to do on technicals. They don't work as well as the indexes do. But you can see that this stock is really struggling. If you own the stock and you didn't know what it was, you'd probably sell it right away, be my guess. Wealth management. So thinking about what happened in the Oval Office on Friday, it doesn't give you the warm and fuzzies to want to go out and buy stocks, does it? Makes me want to, invest in defensive fixed income, really. But I think Zelensky did not do himself a favor. They had a deal made. It looked like, certainly seems like they had a deal made. The Trump administration thought it was a photo op. Zelensky came in with the attitude, yet he needs more. He didn't agree to the deal. And so it makes both sides look very unprofessional. The good thing that came out of this, we think that there probably will be a deal, but the good thing that came out of this is that Europe is now understanding they need to really ramp up their defense spending. If you have Trump in office, he's very disruptive. He's disrupting his friends and allies as well as his enemies. So just Europe needs to look out for themselves a little bit more rather than relying on the U.S. to do everything or do a lot of heavy lifting. So we think that kind of longer term, thinking about this a little bit, what the big risk is. The big risk is that we alienate all of our friends and allies, and that the dollar becomes less of a reserve currency, which would really hurt our overall economy and our ability to finance our debt. So that's something to think about. That's where sentiment comes in and out. We really didn't think that there was much odds of that would occur. Even with the BRIC countries trying to do their own currency, we don't think there was a high probability. Now we'll see how this plays out. Maybe it's more of a risk than what we thought, but still not a big risk at this point. When you think of really successful investors, okay, Warren Buffett, Carl Icahn, Stanley Druckenmiller be my favorite. You think of value investors, right? These are great value or opportunistic sort of investors. They don't buy momentum. They're not momentum investors. Momentum investors like to buy high and then basically ride it until they get kicked off. So what we're seeing in the technology space is the momentum investors potentially making a big mistake and extrapolating so much growth in that AI space. So we do think AI is going to grow. NVIDIA, maybe next year is their peak in earnings. It certainly doesn't support the valuation on revenues that it's currently getting versus a company like Microsoft. So what we're thinking about is that over time in the tech sector in particular, that margins, operating margins, gross margins, they revert back to a mean because there's competition, there's capitalism. It's rare that you have companies like Microsoft and maybe Google and a few others that can put a moat up and really defend those margins over time. So as competition comes in, clearly there's going to be competition in the chip space without question. That is going to be really tough on some of these stocks. So I think we had a bubble in technology. The bubble is being broken, is being burst, and the stocks are kind of coming down to a more reasonable level. So maybe it's not the bursting of the bubble like we saw in 2000, but clearly it's starting to happen. So we think that these technology stocks, that they're at multiples that are not sustainable. They have to correct. AI is still going to be a big thing, but probably it doesn't go on the path of high expectations on top of high expectations on top of high expectations, that you're going to see a flattening out of this build out phase at some point. We think is maybe next year, that maybe next year could be flat to down versus where it is this year. So keep this in mind. We have expectations that are changing. The dogs are doing better. The value stocks are doing better. There's really interesting stocks in the stock market. That's self-correcting itself. The market is finding those stocks. We have an oversold condition. We have sentiment that's really negative. As long as this doesn't roll into a nasty recession or maybe just a recession on paper, I think the stock market has some upside this year, 5 to 10% from where it is currently. But we have to follow the technicals. The technicals are going to tell us how to play this. So if we break through that 200-day moving average, everybody should be very defensive. And if you have any questions about what we're doing, what we're thinking, please ping us. Oh, so I've got an update for you. So the FBIO, Fortress Bio, we think that's plotting along. The Journey Medical is a big part of the valuation of that company. It's if you do what what FBIO owns of Journey Medical, Derm, you get a stock price that's 50% higher. Checkpoint, which they also are an owner of, they look like they are plotting along and will get some sort of a license deal for a larger drug company to expand out the indications of their drug and to commercialize the approval. They've already had their drug approved, but then to commercialize it. So that's all good. What I like to see out of FBIO Fortress is for them to initiate a dividend when they get these big hits, because I think very highly that the Journey Medical at some point in time will be sold. They could receive, maybe $200 million. So at a $40 million market cap, that's a big hit. Pass along some of that to the shareholders is my idea. Anavex, okay? They were at the Cowen conference on Monday. They had a really strong presentation. The incremental news there was that they're seeing an acceleration of big drug companies looking at their company. So obviously, Anavex is not going to commercialize their Alzheimer's drug. It's going to be done by somebody else. So the fact that this is happening so that they're getting a lot of looks is really positive. I think that the upside over time of this stock is much higher. So they've got a lot of data points coming. Some of it may not be, could end up not being positive, but we do think they got a really good shot of getting approval of their drug in Europe and then filing in the U.S. sometime this year as well. So again, come to my website, Patrick Adams CFA, sign up for a hard copy of Market in a Minute. We'll send that to you every week. Please hit like. If you have any questions, let us know. If you like any help on managing your money, also please let us know. This is a trading market, and be nimble.